During the week, the rupee tested a low and high of 73.12 and 72.78. The rupee held the stiff resistance at 72.80 due to determined intervention from RBI. Despite the strength in the dollar index and rise in long-term US bond yields, the rupee remained resilient and it tested a high of 72.78 today. The market is wary of intervention to prevent and curb any further strength in the rupee exchange rate, and the central bank has signaled its intolerance for a rise in the rupee beyond 72.80 by indicating its intervention through spot, forward and futures segment in the exchanges. The central bank's intervention stance indicates their intention to manage volatility in the exchange rate and to restrict any unprecedented gains in the currency past 72.80 level on a sustainable basis. With the portfolio and FDI inflows pouring from October 2020 onwards, the rupee has gradually appreciated and now trading in a tight range between 72.80 to 73.25. At this point of time, it is imperative to review the approach to be followed by importers and exporters to hedge their forex exposures and the tenor up to which the hedges are required. Maintaining our view, the rupee shall remain broadly steady within the 72.70 to 73.50 range till the end of March 2021. We strongly advise the exporters to hedge their receivables up to 6 months tenor against the anticipated exposures to derive the benefit of higher forward dollar premia now available in the swap market. This approach will enhance the export realization. The forward dollar premium for a specific maturity of 3 months currently overstates the expected level of rupee depreciation over the comparable period. The importers are recommended to hedge their payables up to 1 month maturity and leave the medium-term payables unhedged by keeping a stop loss at 73.50, which is about 50 paisa per dollar higher from the current spot level of around 73.00. Over a period of time, if the hedge cost reduction representing the savings in forward dollar premium exceeds 50 paisa per dollar or so, the stop loss level can be revised to the next support level of the domestic currency at 73.80, which is the new step-up stop loss level. By adopting this process, the importers shall derive the benefit of a favorable exchange rate for settlement of import bills. The fixation of stop loss and step-up stop loss levels shall ensure that the importers are not exposed to currency risk in the event of a sudden fall in the rupee exchange rate. India's exports grew 5.37% year on year to USD 27.24 billion in January, and imports during the month rose 2% to USD 42 billion, leaving a trade deficit of USD 14.76 billion as compared with the trade gap of $15.44 billion in December. The rise in exports was supported by healthy growth in pharmaceuticals and engineering sectors. The lower oil prices and reduction in gold imports limited the growth in imports by only 2%. The BSE Sensex registered a huge rise of 9.32% in this week. The domestic stock indices are registering its all-time high on each consecutive day from Wednesday this week. During the period from 24th March 2020 till 5th February 2021, the benchmark BSE Sensex showed a whooping rise of 98%, quite unexpected by the market. Moody's on Wednesday said India's fiscal deficit projections are higher than expected and slower consolidation will constrain its fiscal strength over the medium term. However, it expects India's nominal GDP to rise closer to 17% in FY 2021-22, higher than 14.4% projected in the budget. Instead of buying spot dollars from the market, RBI's intervention strategy is now focused on forward maturities, which factor lifted the forward significantly higher across the tenor. Specifically, the 3-month forward dollar premium is quoted at 5.75% per annum. The forward market differential between the 3-month and 6-month tenor has contracted to 0.40% per annum as compared with 0.65% a fortnight ago. The higher forward dollar premium now prevailing up to 6 months tenor encourages selling by exporters and abstinent from importers in view of the rupee's continuing stability against the dollar.